Morning guys, Joel Frank here, market analyst for YouTrading, and today we're looking at the US dollar, or more specifically, the US dollar index, the DXY, not the Bloomberg one, the other one. As you can see, in the past, 2.5 months now? You can see I've got it, the chart here is daily candles. And in the past 2.5 months, we've been under quite a lot of pressure. The DXY sort of found its annual high in the mid 9300s, but since then it's been falling. From a fundamental perspective, it's been coming under pressure. I mean, there's a couple of reasons really, but I think the main one for me is the fact that US real yields, so inflation expectation adjusted bond yields in the US, are still very low and remain very subdued. And obviously when real yields are low, that reduces the incentive to invest in a currency, basically. So that has been weighing on the dollar heavily. Now, why are real yields so low? Well, it's a combination of two things. Inflation expectations have been rising rapidly. Obviously, there's been a lot of concern about inflation. CPI and PPI are at like multi-year highs. Core PCE data is going to be out for the month of April at the end of this week. Should be pretty high. It's going to be way above the Fed's inflation target. Although obviously and this is another key factor, whilst inflation expectations are really high, the Fed is not responding to that rise in inflation expectations with hawkishness. They're actually shrugging off these concerns about inflation and saying that inflation is just, this spike in inflation that we're seeing is going to be transitory. So the fact that inflation expectations are really high, but the Fed is saying we're still going to remain dovish, well, that is something that is basically very bearish for real yields and appears to have been very bearish for the dollar. So yeah, let's talk about the technicals. Obviously, as you can see, just looking at these moving averages, you got the green, this is the 200-day moving average in green, the 50-day moving average in blue, the 21-day moving average in orange. They're all heading lower. You can see dollar's kind of been respecting this descending trend channel as well. So technically speaking, it's all looking very bearish. Literally just today, we broke below quite an important level of support. That was the low of the 25th of February, around 89.60. We're now below that in the 89.50s. And now because we have broken below that, there's not really any technical support ahead of this annual low. Is that the annual low? Yeah, the January 6th low. And that's around 89.15. Now, we have to zoom out quite a lot to see where we're heading if we do break below that level. But yes, if you look back to early 2018, you've got these multi-year lows just above 88. So in the coming weeks, if the Fed stays dovish, if inflation expectations remain elevated, and if real yields remain under pressure, it does seem likely that the dollar is going to continue to grind lower within a trend channel, perhaps this one. And it does look likely that we could be testing this level here. So that's a key one to be looking out for, guys. Hope you enjoyed the video, and I'll see you all in the next one.